Welcome to the Snowbirds Expat Radio Podcast, powered by the Snowbird US Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, hello everybody. We've got the bases covered again. We've got Toronto, we've got Maui, and we've got Linda Leong, who is our guest today. And Linda, tell us about the firm you work for. Tell us about your job. And then I've got some great questions today that really is a little bit more broader for a snowbird who's going to be traveling down south, and what kind of exposure do they have other than sunshine. We'll be covering a few other things. So, Linda, tell us something about yourself that we don't know.
Okay, so Linda Leong. I'm based out of Toronto. I'm a principal in our cross-border tax group at Doane Grand Thornton. I've been with the firm just under a year, but really enjoying it so far. I'm going to say we're a proudly Canadian firm. Our founder, Harvey Doane, was a Nova Scotian. And so really proud that we're a Canadian firm. We offer a broad range of tax services, cross-border tax planning, U.S. personal tax compliance, and global mobility services for those employers that have employees that are moving, to Canada or U.S. or vice versa, just working in both countries.
Now, it was called Grant Thornton, but now it's called Doane Grand Thornton. So that was the acquisition and merger of Doane coming in?
Well, it was more, I think we wanted to emphasize our Canadian roots. We just didn't have Doane there. So Harvey Doane founded the firm, I think in 1939. It's an 85-year-old firm. And so I think we just wanted to emphasize we're going back to our roots, that Harvey Doane, who was a Nova Scotian who bought out his partner, started the firm. And so we just wanted to go back to our roots and emphasize our Canadianness, I guess.
Well, it's pretty important that we talk about Canada as much as we can, because obviously since January the 20th, it's been pretty difficult on Canada with all the everything going back and forth between the United States and Canada. Not from a personal point of view, because we've a lot of great friends here that we work for, and a lot of Americans living up in Canada, but it's just become a little bit very loud from a political point of view. So we won't touch base about that. We will touch base that it was so nice to see Canada beat United States in overtime during the Four Nations Cup. So that helped me a lot, because I was criticized so much. And I told the story a couple weeks ago. I'm over here in Maui, and I'm golfing at a private golf club called King Kamehameha, and I sunk a birdie putt, and all my American friends were reminding me that it's actually a 4 because of the 25% tariff.
Oh.
So it went from a 3 to 4. So I remind them that they are a democratic state, and they never asked for this either. So, but anyhow, let's get into the questions, and this is going to be more of a broader really about snowbirds traveling south. So here's the first question we're going to ask you, and we're going to go easy on you because I know Linda's not feeling very well today. So we're going to be, we're going to cut her all kinds of slack. Okay. So the first question, if I'm a snowbird, what are some of the things I need to consider from a U.S. income tax perspective?
Well, first thing is you need to make sure you're tracking your days across the border. Because you need to be aware if you meet what's called the substantial presence test. And so for U.S. income tax purposes, technically you may become a U.S. resident for U.S. income tax purposes if you meet that substantial presence test. And very generally, how you meet that is if you count your current days, 1/3 of your prior days, and 1/6 of your days before that, and it adds up to 183. You meet the substantial presence test. I guess that's what you're doing. That's what you're showing me.
I'm just putting in a shameless plug for the Snowbird US Day Tracker. So there you are.
Yeah, that's perfect. So
okay.
I guess I didn't need to go through the formula, because I should have just said go to the app.
That's okay. We want to hear it from someone who really knows what they're talking about.
So, I mean, it's not the end of the world if you do meet that substantial presence test. You would just need to file what's called a closer connection form just to tell the IRS that, hey, I know I'm in the US a number of days, but I'm actually, my home is Canada. So there's a bunch of questions and you fill out that form. Now, if you're, if you're in the US for more than a, like if you're, there's another way if you meet that substantial presence test and you have that 8840, then that's fine. You file it and you're a non-resident of the US. If you're here more than 183 days in the current year, then possibly you might have to go to the treaty and say, look at all my ties, my closer connection to Canada. So there's just a couple ways to do it, either the treaty or the 8840.
Now, there's a lot of discrepancy around the 8840. Does it have to be filed April 15th or is it June the 15th?
I would file it. Tech. So the 1040 NR is generally due June 15th if you don't have compensation, like if you don't work in the US. And then April 15th April 15th if you have compensation, and then June 15th if you're only filing the 1040 NR because of rental income. So I would just file it April 15th just to be safe.
And that's what I say is why wait? We've got all the information on the app for you, so fill out the form. And I know my wife and I just recently did it as well too. So why wait? And of course, it's being filed with the Treasury Department of the IRS, correct?
Right.
Yes.
Right.
Okay, let's move on to the next question. Can you explain how I can be exposed to U.S. tax if I'm not a U.S. citizen, U.S. resident, or a U.S. citizen?
Yeah. If you have U.S. assets, I think, and those U.S. assets exceed $60,000 a fair market value at the time that you pass away. So U.S. assets could be U.S. securities, or they could be, for example, a house that you own in the U.S. Those are the most common, U.S. assets. And so everything U.S. securities or U.S. home that you own directly, so not in another entity. And if the assets exceed the fair market value of those assets exceeds 60,000, then you potentially would have U.S. estate tax. Now, there's something in the treaty that provides for Canadian residents to have this credit to reduce U.S. estate tax. It's called the prorated unified credit, and it's prorated based on your U.S. assets over your worldwide assets. And so how the mechanism works, if your worldwide assets are under the U.S. estate tax lifetime exclusion amount, which right now is almost 14 million, then you would not have a U.S. estate tax liability, but you would still have that obligation to file that estate tax return because you want to claim that treaty credit.
So let's say the average, I want to say not the average person, but I've got $2 million worth of U.S. securities in my Canadian brokerage account. Do I have U.S. tax exposure that I should be worried about?
Sorry, so what was the amount that you had?
So it's $2 million in my Canadian brokerage account that holds nothing but U.S. securities. Do I have exposure?
Yes. Yeah. Because the fair market value of those U.S. securities is over 60,000, then you would have to file a U.S. estate tax return. But if your worldwide estate at the time of your passing, and assuming you're a Canadian resident, is less than the exclusion amount of 14 million, then you would not have a liability. That 14 million, though, absent any legislation, will be reduced to like an inflation adjusted amount of 5 million in 2026, because that rule that made that exclusion amount so large sunsets at the end of 2025.
Okay. Now my beneficiaries are going to love this question. Can I avoid U.S. tax by giving away my U.S. assets?
Unfortunately not. Well, you will avoid U.S. estate tax because you won't have it, but you might trigger U.S. gift tax. And so as a Canadian resident or a non-US person, you would be subject to US gift tax if you give tangible property located in the US or real property located in the US. And so the gift tax rates are exactly the same as the US estate tax rates. They're up to 40%. But you don't have that lifetime exclusion amount. You do have an annual exclusion amount. It's roughly 18,000 per recipient per year, but you know, that's something you need to be aware of. So you can't sort of give away your US property to your child and say, you know, I don't have estate tax. You won't, but then you'd be subject to gift tax. And the bad thing about gift tax is, so you might, if you're Canadian, you might trigger a gain for Canadian income tax purposes. And then let's say you have gift tax as well. There's no foreign tax credit, so you'd be double taxed. So you can't offset, you know, gift tax with Canadian tax.
Okay, so this is another question that we get asked a lot. If I buy a U.S. vacation property, what are the ownership structures that I should consider from a U.S. tax perspective to avoid or to reduce?
Yeah. So I get that question a lot. And first thing you need to do um, is just see why you want to think of a, you know, a different kind of ownership structure. Um, I would first look at the fair market value of the property and, you know, your worldwide estate and see if you have a US estate tax exposure. If you don't, then you know, I would just own it directly or whatever is the easiest possible. I know it's hard to predict what your estate is going to look like when you pass, but you know, you sort of give it a best guess. If you think you do have or you will have an estate tax exposure, there's several structures some people could consider. Um, First thing though, I would look at the more simple ways to hold it. So I would sort of look at one, let's say you're a married couple, I would look at one person holding the property and doing some kind of will planning so that when I pass away, if that asset is in my spouse's hands directly, that it's not subject to US estate tax when they pass away. One thing to be wary of is to avoid holding US property joint with the right of survivorship, because then at death, that property automatically goes to the surviving spouse and and they hold it directly and there's no way to plan around estate tax for when that spouse passes. So potentially estate tax can be levied on the fair market value of that property twice, once when the first spouse passes away and then when the second spouse passes away. So one way to hold it, I guess, is having one person own the property. The other way to hold it is, again, if you're a married couple, and if you both have funds, to each contribute to the purchase of the property and hold it tenants in common. So let's say I own 50% and my spouse owns 50%, and then I do some will planning so that when one of us passes away, there's something set up for the surviving spouse so that that share isn't subject to estate tax when that person passes away. And then getting to sort of the non-direct ownership structures, there's the trust structure where the trust purchase the property. So if the trust, and typically it's a Canadian trust, if the trust buys the property, then that property is not included in the individual's estate. And so it's not subject to US estate tax. But again, under Canadian tax rules, there's that 21-year rule where there's a deemed disposition at 21 years. So that planning is sort of has a timeline. And then because the trust owns that property and not the person that sort of funded the trust, you know, let's say I put money in that trust and that trust purchased the property and my spouse is a beneficiary, I can only use that property technically because I'm married to my spouse. I don't own that property anymore. So you need to make sure that your relationship is, sound, because basically that's not your property. Other people look at maybe a Canadian corporation, but then if you use that property for personal purposes, there could be a sort of a shareholder benefit. So there's a Canadian tax implication potentially for that. So, I mean, long story short, I would go the simple way. I try to own it directly, um, estimate what your liability is, then maybe look at potentially a trust, but there's pros and cons for each alternative.
Now, do you find that people just come to you and they come to you after the fact and say, "Oh, Linda, we bought a house in Maui. We love it. We don't know how to hold it. Oh, by the way, we close on it in 7 days." Do you find a lot of that, or do you find people really are seriously planning when it comes to U.S. ownership?
I've had a mix. Honestly, I have had some people that have, told me after the fact. So yeah, I've had a mix, but yeah, much better to do that planning before you purchase the property, because you don't want to trigger a gain. Let's say you are putting it in a trust. You don't want to randomly hold, like have a joint with the right of survivorship and thinking of severing it. It's more complicated. So yeah, I mean, to your point, I have seen that, but again, it's much better to plan for the purchase of your property before you actually do it. It's much harder to change a structure that's already been set up.
And someone like yourself, being a U.S. and a Canadian accountant, can give them the best advice,
Yeah,
rather than
that's right.
some realtor who is charming, intelligent, but knows nothing about the Canadian buyers. So
Yeah.
really, that's really is important, is to talk to a cross-border accountant.
Yeah, I mean, that's a really good point, because a lot of times people rely on a US lawyer, and they have certain structures or ownership structures that are only good for US residents. And so, yeah, it doesn't apply for a Canadian resident. In fact, it could create some difficulties. And so, yes, that's a very good point. I would recommend that people consult the advice of a Canadian and US tax advisor, and not just rely on a sort of a US lawyer or US tax advisor, because they don't know the intricacies of cross-border tax.
We had a podcast a couple of weeks ago, and we were talking to this one lawyer who is licensed in Canada and in Florida when it comes to if you're involved in a car accident. And
Yeah.
you really do need to seek out somebody who understands underinsured motorists in Canada, third-party liability, because United States, everybody is uninsured or doesn't have enough insurance. So you need that U.S. attorney, as you do need Linda on the cross-border accounting side. So it's becoming very popular. I mean, if I'm out this afternoon, I'm going to be probably out of a group of 30, 40 people. The group will consist of at least, 30, 40% of those people being Canadians. So
Yeah.
this has
Well,
become a very, very big role for places in
yeah.
Florida, places in Maui, etc. So
Yeah.
the next,
Yeah. Okay. Go ahead.
no,
It's
go
just
ahead.
also, I always, people always talk around the pool, and then they always come and say, why does so and so have a trust and I don't have a trust? Well, everyone's different. Maybe so and so's liability is bigger. Maybe, maybe it makes sense for them, but it doesn't make sense for you. Maybe, I mean, you can't, it's not a one solution fits all. I think some people always feel left out, or they feel like they're missing some deal if they don't have some complicated structure. And, it's not necessarily the case. Sometimes being simple is the best answer.
Yeah. Now we also find, and I look forward to your response, your comments. A lot of the business people that I know have a ton of money trapped in Canadian corporations, a bunch of cash, and they want to use that cash. So what do? They take all that money out of the Canadian corporation and they buy a Canadian property, a U.S. property, believing that the Canadian corporation can own it. Is that possible?
Well, the corporation can own it, but if you use it for personal use, there's a shareholder benefit attached to that
Okay.
for
And let's
Canadian
quickly
tax
touch base.
purposes.
Let's quickly touch base about that shareholder benefit and how it really could affect somebody by using those corporate dollars to buy that personal
Well, they would
property.
impute income basically on your tax return, right? So it's like you're receiving income when you're not really. I mean, you
Okay.
could pay fair market value rent to use that property.
And that's a great segue into our next question. What happens if I decide to rent out
Yeah.
my U.S. property, and would I have to pay Canadian tax and U.S. tax?
Yeah. So, first of all, if you rent, technically the person renting it out has a obligation, or sorry, renting it from you has an obligation to withhold 30% of the gross rents. But you can elect to sort of say, to tell them, I'm going to elect and say this is what's called effectively connected income, and I'm going to be filing U.S. non-resident tax returns to report the net gain. And so I'm going to file a 1040-NR, so don't withhold 30% of the gross, because I'm going to report the net and file tax accordingly. And so if you're a Canadian resident, you would have to report that income for Canadian tax purposes as well. But while you're reporting it in two countries, it's not necessarily double taxation, because you would get a foreign tax credit on your Canadian tax return for the U.S. tax that you paid. So you're reporting it in two countries, but you're not necessarily paying double the tax. You're paying the higher tax of the two jurisdictions.
And that treaty protects you from an individual point of view, but not from a corporate point of view, correct? So let's say, for example, I'm renting out I own the property personally, I'm renting it out. So I would have to have a social security number in the States.
Correct. Yeah.
But the treaty will protect me against double taxation. But let's say, for example, I have a corporation that I'm renting the property out. I guess that's corporate. That's just corporate. Yeah. That's just U.S. corporate. So no issues with Canada whatsoever.
No, and I'm not sure what you're getting at. I mean, but I don't know if this is what you're getting at, but, if for whatever reason Canada sees a corporation as owning the property and the U.S. sees an individual owning the property, then potentially you won't get a foreign tax credit. So,
okay. That's kind of where I was going to.
Yeah.
Okay, so now here's the other one. This is a real surprise for a lot of people. If I sell that U.S. property, what should I be aware of?
Well, there's something called FIRPTA. I mean, there's an exception to that, but some exceptions. But generally, a purchaser buying real estate from a non-U.S. person is required to withhold 15% of the gross proceeds of that property. There's exceptions, like if the property is under 300,000 and the person's buying the property and using it as a principal residence. But there's also something you can tell the IRS, look, it's not going to be a gain. I'm going to actually, there's going to be a net gain of, let's say, X dollars. So I'd like to pay tax on the net versus the 15% of the gross. It's called a withholding certificate. So you can ask the IRS for what's called a withholding certificate, so that the buyer does not have to withhold that 15%. But practically speaking, it takes the IRS a long time, I think over a year, to process those withholding certificates. So it's often not a great idea, because you might as well just file the tax return and get the refund back.
Okay, so let's say, for example, I own my home in Maui. I've never rented it out, but I plan to sell it in the next 3 or 4 years. Canadian dollar has gotten too weak. All the same things that people are talking about. We hear about this TIN number, tax identification number. Yeah. So I didn't have to file. I don't have to have a social security. But how important is it for me to have a TIN number before I go to sell my place, knowing that they're going to withhold?
Yeah, you definitely need it, because you need it. Let's say you want to do that withholding certificate. You need that ITIN number. You need it. So yeah, it's important to have that ITIN number before you sell your property.
So as an example, we sell the property for $2 million. How much can I expect that they would hold back? Is it 15% roughly?
Yeah,
which is a large amount of money. Yeah, large amount of money. It is,
especially if you have no gain or little gain, because this is the withholding is based on the gross, not the net gain, right? So it is a lot of money. But again, it sounds like a good idea to apply for that withholding certificate so that there's a lower amount of withholding. It's just that the IRS has been taking a long time to process those withholding certificates.
And we were talking to a family the other day that sold their home, and because of all these government layoffs, they're expecting that certificate to take as long as a year and a half.
Wow.
By the time they get the money back, which
yeah,
is
well,
just...
so you might as well file the non-resident return. I mean, depending on, when in the year you're selling it, and and get the refund back. I know it's a lot of money, but it's just held there for a year and a half, right?
Yeah, exactly.
So
Okay.
Practically speaking, it may not be the best idea.
So is there anything, now that you provided us with all this incredible information, how do people get a hold of you?
They could reach out. So we have the Doane Grand Thornton website, and there's links there. That's the easiest way to reach out, because we get all the emails, and I then will give them a call. I'll chat with anyone who reaches out. Usually, it just will be a 30-minute introductory call to see how I can help, and then we would move forward and give a fee quote for whatever they need, and go from there.
Well, I can't stress enough that this podcast has always been about connecting people with professionals. This is not one of those do-it-yourself podcasts. We're going to give you all kinds of information on how to transact these, the sale of your home or the purchase of your home. So, Linda, thank you very much for your time. I truly appreciate it. I hope you're feeling better. I know we were talking, the last clients we spoke to in I think they were out in Collingwood, out by Blue Mountain. We said that we're going to make our way out this summer to see them in person. So we look forward to connecting with yourself, but truly appreciate your time. I know you're not feeling well, and I'm glad we had this opportunity.
All right. Well, it was nice speaking to you, and thanks for having me.
You're very welcome. Thank you again for listening to the Snowbird Expat Radio Podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.